If you either want to invest in what may be a once-in-a-lifetime type of opportunity with high potential profits, or save yourself from losing money from an event that may go down as one of the worst moves in history, I highly recommend that you watch this video until the end. My name is Michael Wang, and today I'll be talking about Chinese stocks. I'll briefly explain the situation that Chinese stocks are going through and explain both sides of the story, whether this is a once-in-a-lifetime opportunity or your last opportunity to get out now ASAP before it's too late. Before we begin, and I know this is cliche, but please don't forget to click on the like button. It's such a simple deed, but it really helps me get my videos exposed more, and when I get more people watching my videos, that stirs up more discussions and it motivates me to make better content. So if you haven't yet, please smash the like and subscribe button. Without further ado, let's dive right into today's video and take a closer look at why Chinese stocks have been taking a hit. They used to be viewed as a one-way ticket to retirement, but the situation has completely changed recently. And when I say Chinese stocks in today's video, I'm actually referring to Chinese tech stocks in particular. So the Chinese government essentially wants to be in control of the data. The CCP understands that a tech boom is inevitable, so they want to make sure that the boom happens under their terms, their rules, and their control. As such, there's been regulatory pressure on Chinese big tech for reasons of cybersecurity issues and monopolistic behavior. Last November, Jack Ma accused Chinese banks of behaving like pawn shops. Nothing that he said really crossed the line, but it was enough to get the CCP uncomfortable enough to take action against Ma's Ant Group IPO. Of course, the action taken wasn't just based on personal feelings. The problem that the CCP saw was in regards to who's controlling the technology and the data. If Chinese tech giants have full control over their data and they have plans to go public overseas, the CCP wants to make sure that Chinese tech giants don't follow their rules and actually abide by CCP rules instead. Essentially, the same thing is happening with companies like Didi, which is a Chinese version of Uber. And what happened to the price action of these stocks recently is actually quite brutal. The Hang Seng Index overall has dropped significantly, and individual Chinese tech stocks have also shown a brutal beatdown, with stocks like Didi correcting over 50% from its local highs. Now, as an investor, it's important to ask yourself what the essence of the situation is and what action you need to take in order to be profitable in the next 5 to 10 years. As such, we'll look at both the buy and sell sides of the story so you can decide for yourself what the best course of action is. So from the buy side, we have Mark Mobius. He is an emerging markets fund manager and a legendary figure who multiplied the $100 million big assets under management into $50 billion, which is a 500x growth. This is definitely someone you would want to refer to when investing in emerging markets. And basically, Mobius actually sees this crackdown as an opportunity to buy the dip. His logic is that the current regulation may be bad short term, but over the long run, a crackdown on major tech companies provides an opportunity for smaller tech companies in China to grow. He also emphasizes the fact that the major tech companies that are currently under scrutiny are indeed monopolies, and a regulatory action was not only inevitable, but also adequate in a situation like this. So over the long run, this could be seen as an opportunity for the entire Chinese tech industry. As such, he is currently focusing his investments on small to mid-sized Chinese businesses, and just like how Tencent and Alibaba have grown to become huge multinational companies, there's room for other smaller Chinese businesses to grow as well. And due to the sheer scale of the Chinese economy, he believes that global investors will return eventually. The other perspective is the sell side perspective. Cathie Wood, who's a CEO and CIO of one of the hottest companies in finance right now, ARK Invest, has recently sold a huge chunk of her Chinese tech positions. In ARK's largest fund, the ARK Innovation Fund, ticker ARKK, a $22 billion large fund, she exited almost all Chinese positions except for a real estate service company called KE Holdings. In their FinTech Innovation ETF, ticker ARKF, they sold 30 $58 million worth of Tencent stocks, $64 million worth of JD.com stocks, and 107,000 Alibaba stocks as well. She also sold her Baidu and BYD stocks, which she previously said that she had no thoughts of selling. In a webinar that was held in July, she did mention the need to re-evaluate Chinese stocks, saying that with governmental concerns, the upside incentive is decreasing. There may be a valuation reset as people see the Chinese government as being in charge of these companies. But what's also worth noting is the fact that in ARK's Autonomous Technology and Robotics ETF, ticker ARKQ, JD.com and Baidu are still part of the top 10 holdings. So what can we learn from these two institutional investors? Well, in fact, they're not saying different things at all. With the current crackdown on major tech companies, Mobius is seeing an opportunity in smaller tech businesses, while Cathie Wood sees it as a situation where selling major tech stocks would be a prudent decision. Now, what is my take on these Chinese stocks? Personally, I refrain from trading or investing in them, not only due to the lack of transparency, but also due to unexpected regulations from the CCP. In the case of Alibaba, for instance, of course, it's a major company that's too big not to be transparent, but that's not the only problem with Alibaba. Alibaba has a lot of foreign capital invested, and the Chinese economy benefits from this, so it's too big to fail. But if regulators don't want Alibaba to be too large or too profitable, as it may hinder the control of the CCP, the upside gain is also limited for the stock as well. So in the end, despite having taken a huge hit from external factors, the stock may have a poor risk to reward ratio, and I wouldn't enter a stock with a poor risk reward ratio. In the US, you can be too big to fail, but in China, you can also be too big to succeed. So that is it for today, guys. I hope this explanation on the tech giant crackdown taking place in China was useful. If you guys found this video to be helpful, please don't forget to smash the like button and subscribe so you can see more videos like these in the future. Thank you guys so much for watching, and I'll see you guys in the next video.